Thank you, Elaine. Eurozone countries will bail out Spain's struggling banks with $122 billion. Spain will have to restructure its banking sector in return, but investors are still concerned if the country will need more help in the future. Jack Barton reports from Brussels.
Spanish workers continue to protest against rising unemployment, wage cuts and tax hikes. But there'll likely be no respite from the country's austerity programme, especially after Eurozone finance ministers finalised a rescue deal on Friday that will drip feed up to €100 billion to troubled Spanish banks. EU officials insist Spain will have to stick rigidly to its budget-slashing measures if it wants to receive the money. Brussels insists the reforms and bailout will help.
To create an economy which is more competitive, which stands on more stable foundations, and which is able to create, to generate growth in a more sustainable way.
That message was aimed at the markets, and the markets didn't buy it. As soon as the deal was announced, Spanish borrowing costs shot up well above 7%, the unsustainable level at which Portugal, Ireland and Greece all required much larger rescues.
It's a very fragile and maybe even a dire situation, because if you look at the fundamental issues, nothing has really been solved.
Still mired in recession, Spain's unemployment rate has climbed to a quarter of all working-age people. New statistics also reveal almost 9% of Spanish bank loans are unlikely to be ever repaid, a higher portion of toxic debt than previously thought. And that's not the only problem now facing the country's banks. Fears of a banking sector collapse have seen Spanish deposits fall by 6% this year alone. And while it's being described as more of a jog than a fully fledged bank run, it's nonetheless a trend that EU officials are keen to stop in its tracks. If Spain requests it, the first portion of the banking sector bailout will be ready for dispersal by the end of the month. Jack Barton, CCTV, Brussels.